Let's break this chart down step by step and understand what the market is really doing. Starting from the left side, we clearly see a change of trend. The market shifts from bullish to bearish and begins forming lower highs and lower lows. That tells us sellers have taken control. When trend changes, our mindset must change with it. We are no longer looking for buys. We are now looking for short positions. After the initial change of character, price continues and even gives us a bearish break of structure. This is important. It confirms that the shift was not temporary. The market is now structurally bearish. That means our focus becomes clear. We wait for a pullback to a premium area to find a high probability short setup. Now the question is, where do we enter? We look for the origin of the impulsive move that caused the structural break. That origin is our order block. This zone represents institutional activity, where strong selling pressure entered the market before the major downside expansion. So we mark that area carefully. But how do we know this order block is valid? First, on the lower time frame, we observe a bullish internal shift before price returns to the zone. That tells us the market is retracing, not reversing. It's simply pulling back into premium. Second, price creates inducement before tapping the order block. This inducement is designed to trap early sellers and mislead retail traders. Liquidity is engineered above short-term highs, then price continues upward into the order block. This manipulation strengthens the probability that the zone is legitimate. Now price reaches the order block. This is where patience matters. We do not enter blindly. We wait for confirmation, such as a lower time frame bearish break, rejection candle, or internal structure shift back to bearish. Confirmation reduces risk and increases probability. Now let's talk about targets. At the lowest point of the move, we clearly see sell-side liquidity resting below equal lows. This is extremely important. The market moves from liquidity to liquidity. Since buy-side liquidity was used during the retracement, the next objective becomes sell-side liquidity below the lows. That liquidity is the fuel for the continuation move. So our plan is simple and structured. Entry after confirmation inside the order block. Stop loss placed slightly above the order block with a small buffer to avoid being taken out by wicks. Not too tight, not emotional, logical placement. Target sell-side liquidity below the equal lows. This gives us a clean risk-to-reward setup aligned with structure and liquidity principles. But remember, none of this works without proper risk management. Risk management is the real reason traders survive long-term. Risk only a small percentage per trade. Do not over-leverage. Accept that losses are part of the game. Consistency comes from discipline, not from one big win. Structure gives direction. Order block gives location. Inducement gives confirmation. Liquidity gives target. Risk management gives survival. That is how professional trading is done. Follow for more structured breakdowns and deeper smart money concepts.